In today's video, we're going to be talking about a few different earnings that were pretty crazy. So we're going to take a look at Microsoft earnings, which, by the way, Microsoft is my largest stock in my entire portfolio. And we're also going to take a look at Tesla earnings, which is a smaller stock in my portfolio, but it's still a pretty decent size. And I know you guys want to see that. Most of you are probably here for that one. So we'll start with Tesla. But we'll also take a look at Caterpillar stock because they just announced earnings today too. And that's a stock that I really want to own, but I do not currently own it yet. So we'll take a look at all of those, and I'll let you know if I'm making any changes to any of my positions or if I'm kind of just holding or what I'm doing. So should be a fun one. I hope you guys enjoy this quick update. Let's get started. What's up, everyone? My name is Ale. Welcome back to my world of stocks. All right, let's not waste any time. Let's go ahead and kick things off with Tesla, who smashed earnings. So let's take a closer look at what happened. Okay, so as CNBC is reporting here, Tesla did crush earnings. And I'm going to take this little portion of the report where it shows expectations, and we will overlay it over Tesla's earnings report so that we can have a better look at everything. Okay, so CNBC says that Wall Street was looking for revenue of $6.33 billion, and Tesla did technically miss there, reporting revenue of $6.3 billion, so a miss of around $30 million, which is also down year over year by 8%, but that was mostly expected to happen since Tesla is going all in on selling cheaper vehicles like the Model 3 that don't bring in as much revenue per vehicle as something like the Model S or the Model X that charge much higher prices. But either way, they were only a little bit off expectations there. But what really matters is EPS, as Wall Street was expecting an actual loss of 42 cents per share, but Tesla shocked them and reported an actual profit of $143 million on a GAAP basis and over $340 million on an adjusted basis, which does translate to EPS of positive 80 cents GAAP and $1.91 non-GAAP. For some reason, CNBC reports it there as $1.86, but I think it should technically be a little higher than that at around $1.91. But either way, they destroyed those estimates. Now, when looking at margins, CNBC doesn't say what Wall Street was expecting, but Business Insider did give some projections yesterday. And while their overall estimates did look a little different than CNBC, they cited gross margin expectations of around 17.7%, but Tesla beat that number as well, as they reported GAAP gross margin of almost 19% and automotive gross margin of almost 23%. So while this was a transitioning quarter for Tesla, moving from higher priced vehicles to lower priced ones, they were still able to turn a profit that literally nobody was expecting. And that sent the stock soaring by over 20% at one point. It's pretty crazy to think that it was only a few months ago that this stock was trading for less than $200 a share, and everyone, including the mass media, kept saying that this stock was going to like $10 a share, which pretty much would equal to them being, practically bankrupt. So that's kind of crazy that the stock has really recovered in a big way. Anyway, a couple other things that Tesla noted in the earnings was that the Gigafactory in Shanghai is now completed ahead of schedule in just 10 months of building, and they also explained that it is a massive 65% cheaper to build cars in the Chinese factory versus here in the United States. And that's something that I kept mentioning in my videos, is that once the factory is up and running, it's going to dramatically help lower costs for them because everything is built so much cheaper in China, and China is the absolute biggest market in the world. In fact, it's the largest EV market. It's even larger than all the other countries in the world combined. So there's plenty of demand in China to keep that factory busy, pumping out as many vehicles as possible. And here we're being told that it's going to be at a 65% cheaper cost, which is absolutely fantastic. On top of that, they mentioned that the Model Y production is also ahead of schedule, and they may even start pumping out those vehicles as early as summer of next year, which was initially planned for fall. So that's a pretty big deal as well. And that's the vehicle that I'm really waiting for myself as a shareholder, because it'll have much better margins and target a much larger market than the Model 3, as crossovers are by far the largest vehicle segment in the entire world. And finally, I'll just add here that they're even making progress in their energy segment with record storage deployment and solar growth quarter over quarter of almost 50%. So am I adding to my Tesla position at these levels? Probably not, because it's been climbing quite a lot recently, and at around 7%, I think it's actually like 8% of my portfolio now. I have the position built out that I really want to have in Tesla at this moment. So as a long-term investor, I will just be holding my position for now and kind of seeing what happens in the future, but I'll definitely make some update videos. And I did not have time to listen to the earnings call because there was other stocks that I had to get through in this video, so I was doing some research and I was trying to put everything together. But I will listen to the earnings call after I put out this video, and maybe I will mention it in a future video as well. Anyway, congratulations to all of the Tesla bulls if you were holding the stock, and I guess I'm sorry Tesla shorts. Well, actually, I'm not that sorry, but anyway, congratulations to the Tesla bulls, and we'll have to just kind of see what happens, but I'm pretty happy with everything I saw in this quarter. But anyway, that was Tesla. Let's move on to Microsoft. All right, guys, up next is Microsoft, which is my largest stock, and in my opinion, they absolutely crushed earnings, even though the stock didn't really reflect that. But let's take a closer look at what happened with them. Okay, so they reported EPS of $1.38 versus estimates of $1.24, so a beat of 14 cents there. And they reported revenue of $33.1 billion versus estimates of $32.23 billion, so almost a beat there of $1 billion, which is very nice. Now, revenue increased by 14% year over year, operating income increased 27% year over year, net income increased by 21% year over year, and diluted EPS increased by 21% year over year as well. So incredible growth all around. Now, Satya Nadella, the CEO, which by the way is one of my absolute favorite CEOs in the entire world, cited cloud strength during the earnings, saying that the world's leading companies are choosing their cloud to build their digital capabilities. They also returned nearly $8 billion to shareholders in the form of dividends and share buybacks, which was up by 28% year over year as well. This is really incredible. Microsoft is such a well-run company. I can't believe that they continue to grow at these very high rates and still manage to return so much money to shareholders. This is why Microsoft is my largest stock, and whenever it really pulls back or dips in a major way, I just know automatically that it is an instant buy on every dip because, again, it's just such a well-run company. Anyway, if we take a closer look at that cloud segment, we can see that intelligent cloud revenue increased by 27%, driven by server products and cloud services, which was up by 30%. And this is why I keep saying that Microsoft Azure is just as important as Amazon Web Services, because Microsoft bundles it with all of their amazing software and services that makes it a compelling option for all businesses. Look at their Office commercial products and cloud services revenue that jumped another 13% as well, with Office 365 jumping 25% also. That's because Microsoft comes to businesses and says, look, go all in with us. Get Azure and get all of these Office products and services that you know your business will need to use every single day. And that's a very compelling offer that they make to businesses. So they do very well. I think Azure is more important in the enterprise than even Amazon Web Services. And by the way, their LinkedIn acquisition continues to perform incredibly well, as LinkedIn grew another 25% year over year as well. So that's very strong performance also. Now, the stock barely moved. In fact, it's not even up by 1%, which is pretty hilarious, but I suppose for Microsoft, that's pretty normal. Wall Street never really reacts wildly to their earnings. In fact, there's actually been times where they announce great earnings and the stock actually drops, but that's not really a big deal for me because Microsoft is one of those companies that I really plan to hold long term, either until I retire or unless something really dramatically changes with their business. Also, you have to keep in mind that they're still trading near record highs right now and have already climbed by over 200% in the past 5 years. So as my largest position of well over 25% or so of my portfolio, it still rewarded me very well over the years. You also have to keep in mind that the valuation is a little rich with a forward P ratio of 23, but I think that's more than justified considering their amazing performance. This is a company that does well over $100 billion in sales every single year and are still expected to grow by double-digit rates into the future. It's not exactly easy to find giant companies like this that are also incredibly profitable and still grow their revenues by double-digit rates. On top of that, I think Microsoft is a pretty good dividend growth stock, as their dividend only yields 1.5% at current prices, but that's also because the stock has soared over the years, and with a payout ratio of less than 50%, a double-digit growth rate, and almost a decade of consecutive growth, it's easy for me to hold this stock very long term. So I'm not really adding to my position at this moment because it's already my largest stock. I did most of my buying at under $100. I don't really want to add when it's, trading near record highs, but I still really believe in them for the long term. So if they were to dip maybe like 10% or more from these levels, then I would actually consider adding to my position even though it's already my largest stock, because that's just how much I believe in Microsoft. But anyway, great earnings. I really liked everything I saw with this earnings, and Microsoft continues to be one of the best companies out there in my opinion. All right, and finally we have Caterpillar, ticker symbol is CAT, and this is a stock that I do not currently own, but it is one that I've really been wanting to add to my portfolio. It's one that's a very high priority on my watch list right now, especially because of the dividend. Very reputable company, strong brand, strong moats, and I wanted to really own this stock over the long term for the dividend. So I was really hoping that earnings would be very horrific and the stock would crash and give me a buying opportunity. And actually that's what a lot of the analysts and the media were all saying. We recently talked about this in a previous video, but they were all saying that this quarter was likely going to be very weak. And that is actually what happened. They were actually right for once, and earnings were actually pretty bad for Caterpillar. But unfortunately, for some reason, the stock actually climbed for the day, and I didn't really get my buying opportunity. But let's take a closer look at what happened. Okay, now the stock did actually drop at first by over 6% in pre-market trading, but it later rallied and actually finished the day up by over 1%, which is kind of funny because Microsoft climbed even less, and Microsoft had an amazing earnings, but Caterpillar wasn't so strong, as we'll take a look at in a second. But they're also up by almost 4% for the week. Again, I wanted to own this stock primarily for the dividend that yields over 3%, has a pretty low payout ratio of only around 30%, a very nice growth rate of almost 14%, and 26 straight years of growing that dividend even through market crashes and recessions. But as CNBC reports here, they actually missed on both revenue and EPS, as they reported EPS of $2.66 versus analyst estimates of $2.88, so a miss of about 22 cents per share. They also reported revenue of $12.758 billion versus expectations of $13.572 billion, so that's a pretty decent miss of around $800 million, and I believe that's also a year-over-year drop of almost 7%. And as if all of that wasn't bad news enough, they even lowered their guidance for the year, which they've already done in the past, and with only one quarter left in the year, it's not a very good sign to have to lower guidance again. But as far as the reasons for the weak quarter go, they cited a reduction in inventories from dealers, meaning that dealers that sell their equipment are probably ordering less machinery to sell, and they also noted that this is all due to global economic uncertainty resulting from trade tensions and other factors, which, by the way, sales in the Asia-Pacific region declined by 13% because of lower demand in China. That's a pretty big deal because Asia is actually the area where they need to really expand into, but the Chinese economy is so weak right now and tariffs are so high that it's really hurting Caterpillar in the short term. Anyway, some reports out there like this one from MarketWatch citing State Street Global Advisors noted that earnings expectations for the third quarter, just kind of in a broad sense, were already set so low that it wasn't really difficult for investors to see past the weakness due to the expectations of a trade resolution happening sometime soon. But I was really hoping to buy into this weakness and then hold the stock long term and collect that really nice dividend, but unfortunately this damn stock just won't fall. Although I am absolutely happy for anybody holding the stock and the performance that you've been seeing lately. But as someone who is still not in the stock, I personally wanted to see the stock dip and give me a buying opportunity. So it looks like I'll probably have to wait longer until I do get a buying opportunity, if I ever get one. Although I do think that if trade talks break down, I think that this stock would probably get crushed because they are heavily exposed to the macro economy, and the way that it's been kind of trading lately, kind of rising, I think it's definitely rising on the optimism of a trade deal getting done sometime soon. So if that kind of goes away, and we're already seeing tariffs starting to really hurt companies in these most recent earnings, and if that continues or those tariffs actually increase, then companies like Caterpillar would absolutely be in trouble. But at the same time, if a trade deal actually gets done, it looks like Wall Street really wants to own these companies because they are trading at pretty attractive levels even right now, even after Caterpillar rose. Like if you look at Caterpillar in particular, they have a forward PE ratio that is around 40% lower than the sector, while their PEG ratio is also 50% cheaper as well. So because they're kind of a market leader in an industry that, I don't think is ever going to disappear, and they do have a very popular brand and a, decently wide moat, although they are seeing some competition out in Asia, but overall it is a pretty strong brand. And the valuation does look fair and the dividend is attractive. I think a lot of people just kind of really want to own it, even though earnings were pretty bad in my opinion. Anyway, that does it for today's video. I'll be continuing to watch these stocks. I'll give you guys updates whenever there are any. And I hope you guys enjoyed the video. If you did, make sure you hit the like button, subscribe if you haven't already. Thanks for all the support, guys. Leave your thoughts and comments down below, and I'll catch you in the next one. Take care. Bye-bye.